Hello and welcome to this very special video. Actually, we launched our PMS offering about 6 months back, and since then we've been getting a lot of questions and queries to explain the funds and what we do. So I thought I'll make this video and hopefully that will help explain what we are doing and what our thought process is for the funds. So, what we'll try and explain today is who we are and what's our philosophy, what we do in terms of process. We have two funds. We'll go over the frameworks that we use for both of them. What's our risk management process? Why you should be investing with us, and a few case studies, and then the basic operational details. So, who are we? I mean, the fund or the funds are under the PMS of Shree Rama Managers. It's a separate entity from IntelSense. It, this Shree Rama Managers SRM is has been founded by Mohit, who's a friend of mine, and we are in this together. So the whole idea is that we are trying to bring ethical advice, ethical fund management, transparent fund management to which focuses on process, right? Because personally, my entire philosophy has always been to focus on the process because once in a while you might be right, but to be right consistently over very long periods of time, over decades, the only way to do it is to have a good process and to keep improving that process. So that's what we are doing. Uh, So the main people in this PMS is Mohit and myself. I've been uh, investing for the last 22 years, nearing 23 years now. Uh, Mainly passionate about equities, uh, all sorts of equities. I mean, Indian, global. I'm very interested in studying businesses, studying people who run businesses, and that actually led me into the market and sustained my interest for so long. In addition to what we do normally, I mean, I also advise uh, large family offices in terms of their financial allocation. In addition to running IntelSense, the research service. So, what are our key investment philosophies? So, first and most important, and I'll keep coming back to this over and over again, is we want to avoid permanent capital loss, right? So, there are multiple ways of doing it. I personally believe that capital is sacrosanct for us because once you know, getting capital is not easy. Saving, we work hard, save money, and invest. Now, once we lose a major chunk of that money, it becomes very difficult uh, to get it back, first of all. And it also is a very emotionally traumatic experience. If you lose 50, 60, 70% of your capital, then pretty much you're scarred for life in terms of investing. So we don't want to go there. We want to basically avoid bad companies. We want to have reasonable allocations, position sizing, and to top it all up, we use stop losses irrespective of the type of investment. Whether we are doing short-term investing, long-term investing, quant, whatever we are doing, we have stop losses in place so that we understand that uh, we could be making a mistake. Market could go against us at any point in time. So ultimately, we need to be able to get out of losing positions, and I think this is something which sort of differentiates us from other funds or other investors because a lot of people talk about avoiding capital loss, but very few. In fact, I've not seen too many people use stop losses in long term investment. Right, so they go through drawdowns which are 50, 60, 70%, and then they are basically hoping and praying that things will get better. The second most important thing that we feel is we have a long term horizon. Even when we are doing our opportunistic bets, the idea is not bet specific. We are looking at the at a portfolio level, and the portfolio has a long term horizon. We are looking at a few years, at least 3 years, 5 years, 10 years for for that portfolio to continue. So we are not very concerned about day to day fluctuations. We are not very concerned that, okay, one stock pick that we did has gone up 20% in the last 1 week. Should we sell, buy, whatever? So that's not the game that we want to play. We want to basically profit from uh, the cycles that the market in, both the long term cycles and the short term cycles. While we are doing this, we want to focus on management, because that's what creates the sustainability of returns, right? You will not, find companies that that are not very, that don't have very good management, who are going to be able to give sustained returns. And the way we try to do that is we try to have a reasonable concentration. We're not very diversified, and we're not very concentrated, right? So the two funds, and I'll come to those later. One is the long term fund and the other is the opportunistic fund. In the long term fund, we typically will have between 15 to 20 stocks. In the short term fund, we'll typically have 10, 12 stocks. So the whole idea is that we look for opportunities which will give us meaningful returns, and we are very, very focused on the risk management side. The next, very critical thing, this is again a question that keeps coming back to us, is do you have a market cap you know fascination, or do you look at only a particular market cap? We don't. Completely unbiased. We only focused on two, three things. We focused on buying good companies. We are focused on buying companies which have a tailwind, and with good management, preferably good management. Uh, that's what we are looking at. Whether it's a small company, a mid-sized company, or a large company, makes no difference to us. I mean, we've made good returns from mega caps, and we've made uh, good returns from micro caps. So typically we'll have stocks between, say, 2000 crore market cap to maybe 2 lakh crore market cap. So the entire gamut of stocks we cover. The entire focus is on uh, picking companies which will have an ability to grow in the next 1 to 3 years for the long term fund, and in the next 2 to 6 months for the shorter term fund. Uh, Again, like I said, I understand that we cannot know everything about an investment, no matter how much you study, no matter what you do, right? So even the promoter of a company, or the CEO of a company does not know what will happen 2 years down the line or 1 year down the line, and that is the reality. Anybody who runs a business, or is in a reasonably senior position in a corporate, will understand and appreciate this point, that visibility is actually very short term, right? You might have a very good sense of how the next quarter might look like, but what will happen in the next 1 year, 2 years, 3 years, very, very difficult to say. There's so many variables that are out there. So uh, even if, and when the management of a company does not know what will happen, how can we as external investors uh, predict and understand and forecast what will happen to that company in the next 2 3 years? Most of the time, when people say that we are very long term investors, they're basically just projecting the near term, or projecting the recent past into the future. That's what most people do. What we try to do is we try to accept the fact that we don't know, and then have risk management processes. Then we have, then we are going into this with our open, eyes open, knowing that we cannot know everything about a company. And lastly, I think again something which is very very unique to us. Again, if you've been following me for some time, you'll understand that this is a sort of what I would say differentiator that I've been lucky to have created for myself, which is multi-strategy investing. So I do value, I do growth, I do momentum, I use fundamental analysis, I do technicals, I do quant. So all of these things I try to do and put in together in the portfolios. So the advantage of this is that you might not have the best performing fund at any particular time or best performing fund in a year, but most of the time you'll have a more smoother equity curve. Now, what do I mean by that? It means that the journey over the next 3 years, 5 years, 10 years is going to be probably a lot more smoother than people who are focused on only one style. So if what we've seen is last 7 8 years is not being very good for value oriented funds. Last 1.5 years has been extremely good for value and not good for momentum, right? Because that is the nature of the market. Markets keep changing its color, and from time to time, it's like the seasons, right? You've summer, you've winter, you've spring. So all of with the seasons, the flavor of the market changes, the texture of the market changes, and funds who are oriented towards a particular flavor perform very well during that phase when the market is doing well. What we try to do is, because we are multi-strategy, parts of the fund do well most of the time. So you might have, say 20 stocks, out of which 5, 7 will perform well at any point in time, right? So which will give a more cleaner, smoother return profile over a longer period. So the investment process, I think, again, this is a very top level view. What we do is we do idea generation, both bottom up and top down. Uh, Bottom up meaning we look at sectors, which sectors are likely to perform well in the next 1 to 3 years, and then we look at top down, and then we look at bottom up from there, which stocks within those sectors look interesting. That's one way of generating ideas. The second way is we look at our quant models. Every week it throws up new ideas. I have different types of quant models: momentum based, growth based, value based, mean reversion based. So they keep throwing up newer ideas, and ones which fit our particular our fit our particular philosophy, our thought process framework. We then try to do deeper dive based on you know first we try to eliminate. So let's say our idea generation process throws up 10 stocks. We will try to eliminate based on basic criteria. Mostly those criteria is based on financial numbers, promoter history, etc. Out of the 10, maybe we shortlist two or three, and then we'll go and do a further deep dive, qualitative research into those names. And once we then determine, okay, out of those 10 stocks, that we okay that we've owned, we've then shortlisted one stock, we'll then look at the portfolio allocation. We try to look at the timing of entry, uh, and then go for trade execution. Here, trade execution, uh, depending on the kind of stock, might take a slightly longer period. We might accumulate over a period of time. Uh, Keep monitoring. Once we accumulate the stock, we keep monitoring, and then exit based on our sell triggers. Sell triggers typically, I mean, from the quant side is proprietary models that we've built in terms of either it could be a stop loss. Again, we have a multivariate stop loss system. It's not just price based, right? We have multiple variables that go into uh, determining a stop loss, or it could be a profit realization, or it could be more fundamental based in terms of results of a company, etc., etc. And once we are through with all this, we do a lessons learned and process refinement. So from every investment that we do, or every investment that we miss, especially ones where we've studied and then we said and we rejected the idea, and then it went on to become a multi-bagger. We try and go back and try to figure out why we missed those, and what could have been done better. So that's our basic investment process. So we use typically a 9 box framework for our long-term investment. So this is when I talk about the long-term investment, this is the fund which is called Shree Lakshmi. Lakshmi is the goddess of wealth, and the whole idea is to create wealth in this particular fund. So the first, and these are not in any specific order of importance, but we look for all of these. Not always we will get all in one particular investment, but we try to look for as many as possible. So we look for both top line and bottom line growth. We look for a company where the opportunity size is large. What that means is, once you have a large opportunity size, uh, the company can grow again for a longer period of time. That is what typically we are looking for. We are looking for an investment where we can get in and sit for many years, and the stock can keep compounding. We look for strong demonstrated management track record. Why this is important is that you will find a lot of companies coming and giving a lot of sermons, lot of gyan on what they will do, etc., etc., or how great they are. But ultimately, if you go back and see what they've said versus what they've delivered, that is one of the best things that actually tells you what is if the management is walking the talk, and that is something that we focus on, right? And as a corollary to that, that's one of the reasons why we tend to avoid IPOs, because in IPOs you don't have an opportunity to judge if the management talk and the management walk are in sync. Okay. We're also looking at companies with which has low or reducing leverage. So companies where the debt is low, or they're reducing debt very quickly. That's something that we are looking at. We are also looking at companies which not only are growing but also are taking market share from its competitors. If it has any kind of moat, right? Whether it is a brand, whether it's low cost production, whether it's geographical diversification, whether it's some kind of government policy, uh, single source, whatever. So we are looking for something which differentiates the company's business. In terms of valuations, we are not necessarily looking at cheap, because what I have realized over the last 20 odd years is, in India, because India is, I would say, still a reasonably shallow market. Uh, by what I mean shallow, I mean what I mean by shallow market is that we typically have maybe 100 to 200 stocks, uh, where you have some amount of volume in terms of trading volumes, uh, where you can buy and sell in reasonable large quantities. So the universe that you can invest in is not very large if you are investing deploying a fair bit of capital. And within that, if you find good companies, most of the time you will find that they are expensive by any conventional method of valuation. That is more because of the scarcity premium. Because you have so few things which people can buy, whatever people can buy is going to be expensive. So that's the way I look at it, and that's why I'm not very fixated on buying dirt cheap. Right? I am more fixated on buying companies where they have an ability to grow sustainably over a longer period of time. And lastly, we are looking for good management, shareholder friendly, with a good governance track record. Because unless these things are, I mean, unless the management is good and they are shareholder friendly, the company can do well, but as a minority shareholder, we might not get our legitimate share of it. So that's what we look for. So how do we construct the portfolio? Again, like I said, we do both bottom up and top down. The long-term Sri Lakshmi fund has a core and satellite approach. By this, what I mean is, we have some core positions which we tend to have slightly larger position sizes, and we tend to hold for longer periods. And then we have smaller opportunistic sort of bets, a few in number, which We hope that over a period of time we'll graduate into more core positions. But that's how we play the construction of the portfolio. Obviously, if we have higher conviction in some ideas, we'll have higher allocation to it. In general, again, because of risk management, we will not go overboard, will not go, 20-25% in one idea. Typically, the max that we will go is probably 10% as a starting position. And I start personally to get very jittery once a single name goes beyond 20-25% in the portfolio, and then I probably start trading. We also look at non-consensus ideas, something that people are not looking at, uh, or maybe industries which are undergoing some amount of stress at the current juncture, and where the future looks to be brighter. Again, as I said, market cap agnostic. We look time horizon for each pick when we get into is roughly 1 to 3 years. But that doesn't mean that we cannot sell before 1 year or we cannot hold beyond 3 years. The idea is that that's the horizon that we get in for, or that's the horizon that we are evaluating a company's growth and performance for. And if the company continues to perform good or better than what we are expecting, we will continue to hold it, right? So that's the whole idea. And we do have the flexibility of going to cash up to 50% if the situation demands. Personally, in our long-term portfolio, I don't think you know we've ever gone. I've ever gone beyond say 30% of cash. Even in during COVID times, I think that's the max that we went to. Because once you go a lot into cash, then you also start getting into that analysis paralysis kind of problem where you will find it again very difficult to get back into the market, right? So typically, cash positions will depend on opportunities that we are able to find at any point in time in the market. Most of the time we will be fully allocated, fully invested, uh, because again, 3 out of 4 years in the market, you will find that markets are in a upward trending markets are upward trending 3 out of 4 years. So it makes more sense to remain invested in the market. So that's how we go about the long term Sri Lakshmi uh, fund. Moving on to the more agile, the more faster growth oriented fund. This is called Shree Vriddhi. Vriddhi probably denoting growth. Again, here the time frame is 2 to 6 months. We are looking at, so the whole idea is in the Lakshmi fund, we're looking to play the longer cycles, the compounding plays. Here we are trying to look for the short cycle plays. We are trying to look for cyclicals. We're trying to look for opportunistic bets. We're trying to look for turnarounds, those kinds of stories where we might be able to get, between 10%, 20%, 30% returns in say 3 months, 6 months, and then we hope to keep churning. So this is a much higher churn portfolio compared to the long term portfolio. The long term Sri Lakshmi fund will see maybe 25-30% churn in a year. So which means say if you have 20 stocks, maybe 5 to 6 will you know go in, maybe 5 stocks will get replaced every year. Uh, in this one, we might see a very high churn. We might see stocks going in and out every 2 weeks, 3 weeks, 1 month. Not the entire portfolio, but here typically we'll have, let's say, 10 stocks. So maybe 1 or 2 stocks going out every 2-3 weeks, 1 month. So again, what we are looking for growth. We are looking for profitability. Again, we try to look for profitable companies. We're not very keen on loss-making companies or companies which are moving from loss to profit unless we are very convinced about the story. Again, we are looking for low to reducing leverage, because what we found over the years is leverage causes the biggest amount of trouble. Like our first principle, not to lose capital, uh, we try to shy away from businesses, from stocks where we can get into trouble. We're again looking for dominant or increasing market share. We're looking for turnarounds in business. And obviously, because this is much shorter term in nature, we're looking for short-term prospects, whether it is of a technical nature, if there's a demand-supply mismatch, if there is a corporate action coming up. So all of those kinds of things we are looking for in this particular fund. How do we construct the portfolio? We're looking at our proprietary quant models, which is based on momentum and mean reversion. We look at Technofunda. By Technofunda, what I mean is we look at both technical charts and we look at the fundamentals of the company. Create a concentrated portfolio. This is like 10 to 12 stocks. Typically, till now we've had 10 stocks. The reason for 10 stocks is basically the idea is that you should have a meaningful bet when you are getting in, because we are managing risk very very aggressively here. Typical stop losses or typical get out positions are roughly 8 to 12%. So at any particular stock we'll probably not lose more than that. We're trying to get target 20-25% returns, and our time horizon is 2 to 6 months. So that's again completely market cap agnostic. But in this one, we are more cognizant of the liquidity of the stock, because we are trading or going to get in and out. It needs to be liquid. In the Sri Lakshmi long term fund, it does not need to be that liquid, because we are able to buy slowly and accumulate over if required weeks and months. Here, because of the agility and nimbleness required, we will look for higher liquid stocks. So again, I've explained both these funds. Sri Lakshmi is the long-term fund, Vriddhi is the short-term fund. Our benchmark for both is Nifty 500, because we wanted to have a broad basket in universe. Personally, again, I am not very keen on looking at benchmarks, because it doesn't really matter to me as an investor what a benchmark is doing. What matters to me is what kind of absolute returns I am making, and I'm happy if I am making an absolute return every year. uh, because the stock picks or our portfolios have nothing to do with the index. I mean, we don't even look at the index, whether it is Nifty, Sensex, Nifty 500. We don't even look at it. So I personally, if you ask me, beyond knowing that okay, maybe financials is roughly 30% of Nifty, or, I don't even know the exact allocation or breakup of any index. So unlike mutual funds or unlike in a lot of other PMS funds, where the whole idea is some sort of closet index hugging. Uh, they, what they do is they will very closely mimic an index. So if financials is 30%, the mandate will be you can be plus minus 5% of that, or plus minus a certain delta. So if it's 30%, you can maybe go plus minus 3% on either side. So 27 to 33% in a particular in that particular sector. We don't have any of those kinds of guidelines. We are basically looking at creating a portfolio which has a group of stocks which are likely to do well in the time frame that we have chosen them for. At the fund level, minimum investment is 50 lakhs. You could actually, if you have 50 lakhs to invest, you could do a split of 25-25 in both these funds. That's what a lot of our investors are doing, to get a flavor of both, and then they are adding on to whichever one they are more comfortable with. Risk management, I think I already talked about a little bit. Basically, we have three types of risk. We have business risk, we have market risk, and we have a investment time frame mismatch risk. So business risk is, you know, are we investing in the right companies? What happens if we invest in the wrong companies? So what we are that's what we do our due diligence on, both quantitative as well as qualitative research. We look at good companies, good track records, avoid over leveraged businesses. So that takes care to a large part of in terms of business risk. Uh, Market risk again is something where markets fluctuate. A COVID-like incident happens when everything falls. that is something which is beyond an investor's control. Even with that, what we try to do is we avoid very highly concentrated portfolios, and we have our own proprietary multivariate stop losses in place, where we have multiple uh, dimensions of calculating, or multiple variables uh, through which we calculate stop losses. It's at the index level, it's at the individual stock level, using multiple parameters. So it's slightly complex, but it's been working well for us. So that's what we use to uh, you know sort of reduce market risk. It cannot be eliminated completely, because we are invested in a particular asset class. Time frame investment mismatch is that you have a short term horizon, we are looking at a long term fund, or the other way around. You have a 20-year horizon and you are then invested in a very short term horizon fund. So the whole idea is that you should be very comfortable with the time horizon of the opportunities or the kind of stocks that we are looking at in. And that's why typically we have these two funds. One is time horizon and the other is style of investment, because one is low churn, uh, you know, buy and hold good companies, compounding in nature, and the other is high churn, more hits and misses. So it's basically, Rahul Dravid versus Virendra Sehwag kind of thing. Some Sehwag will come and try and hit fours and sixes all the time. Dravid will play consistently, any track, any wicket, and score runs on a more consistent manner. So that's the difference between these two. What do we avoid? As I said, we avoid IPOs. There's no easy way of differentiating the management walk versus stock. And what I have seen over the years is, just before an IPO, most companies actually do a lot of window dressing and makeup, and then present the company's numbers. And immediately after IPO, 2 3 quarters, you see fairly poor results, or even sometimes disastrous results. Uh, so so we tend to avoid IPOs. If the business is so great, we are happy buying it a year, 2 years down the line, after we know that okay, the management is good and they've been performing well, etc. Uh, Obviously, the next is that we don't look at leverage businesses, because 100% of companies which have gone into IBC or VIFR earlier are because of leverage. The multiple reasons why they took high leverage. All of these are basically, either they are companies where management was not very good, or earnings were inconsistent. They took loans and tried to expand capacity at the wrong point in the cycle. The corporate governance issues, right? So all of these things are actually uh, resulting in companies which have catastrophic losses, and that's what we want to avoid. And lastly, liquid stocks. Obviously, we don't want to get into a stock where maybe it trades 100 or 1,000 shares a day, because we will not be able to get in and get out at all without impacting the price. Why you should invest with us? A very important question. I think we are practically the only, uh, or maybe one of the very few funds where we use both quantitative and qualitative approach. We have the man machine model, where we have quant models which are aiding. So a lot of our behavioral biases get taken out by the systems that we've started creating, and that we keep investing on. Like I said, we are multi-strategy. We are not looking at only value. We are not looking at only growth. We are not looking at only turnarounds. We look at all of them. We look at growth, value, momentum, turnaround, special situations, everything. Again, very focused on loss prevention. I think I've spoken a lot about that. We are very focused. We don't do anything other than equities, right? When I don't do anything other than equities, this is all I do. Uh, the research team that I'm slowly building up, that's pretty much all they do. This is what we live, eat, breathe, dream, whatever you might call it. And because we do that, our entire focus is on continuous learning. We continuously look at new business models, new technologies, new ways of investing. So, if I look at my progression, I started as a long-term value investor, went on to car growth, technicals, quant. So, and then I'm trying to sort of create systems which bring the good parts of all of them together, right? So, and hopefully in the future we'll keep trying and continuing to learn and evolve. And lastly, I think which is very something which is very close to my heart. I've tried to be as transparent and as communicate as clearly as possible, because I think that's something very important. When the times are good, it's okay. Especially when markets are turbulent, when the markets are going down, I think clear communication, frequent communication actually helps. These are case studies of some of the stocks that we have. These are not stocks from the PMS, because the PMS we just started 6 months back, but these are from IntelSense Research. So I mean, I'll not go through all of them. Uh, the whole idea is, if you see, we know there are stocks that we've held for 2 3 years with reasonable gains. We've been able to look at and turn around our focus from compounders to some amount of cyclicals uh, before the market moved to that. And again, opportunistic bets, reasonable turnarounds, quick returns in you know so 5 6 month periods we've been able to capture. So these are just case studies or examples of what we are doing. The fee structure right now is, I think, one of, again, very very reasonable. One of the Probably one of the lowest in the industry today. Uh, the management fee is 0.9% per year. That will get charged quarterly. So 0.9% by four for every quarter, one fourth of 0.9%. And the performance fee is going to be 9% of the profits, subject to high watermark. So there's this mistake here. It's not the 31st of December. It will be calculated on the 31st of March, so end of the financial year. So again, sometimes people ask, why don't you have uh, you know uh, uh, some kind of a threshold, and then, so let's say, you have 6% or 8%, after which you charge the performance fee. Now, if you do your simple Excel calculation, what you will find is that what people do is they will they'll have a hurdle of say 8%, and then charge you 20 25% above that hurdle rate. Now, if you do a basic calculation, you will find that nearly all the time, uh, you will actually be ending up paying much more in fees, rather than when you have a very reasonable flat fee. So that's what I've tried to do. Where it's a simple flat fee, there's no confusion. Because we've just started, the whole initially we were planning to have 1.2 and 12%, but just the first few months, we've have an introductory pricing, and this is only for the direct customers or direct investors we have. Exit load, the whole idea of having an exit load, again, you can, uh, unlike Hotel California, you can check out anytime and go out. But the whole idea of having an exit load is to dissuade you from doing that, or basically dissuade people who have hot money and who want to come in and get out very quickly, to come in the first place. That's the whole idea of the exit load. It's not to prevent people from exiting. It's basically to prevent people who have very short term money from coming in, right? So that's the whole idea of having the exit load. Rest are all normal. I think our custodian fund accounting is handled by Kotak Mahindra Bank, and you'll get monthly account statements and all the normal stuff from them. The first 6 months performance for Sri Lakshmi, where is it? Yeah, so the top bar here. So We've made 6.2% in the first 6 months, and when the benchmark of Nifty 500 has done 4.3. Again, personally, if you ask me, I'm not very fixated on the benchmark. So, absolute return 6.2% in the last 6 months. Shree Vriddhi, which is our opportunistic fund, has done slightly better, which is 15%. Again, don't go by the returns. The returns will fluctuate. Sometimes it will be good, sometimes it will be bad. Uh, the whole idea is to understand what we are doing, the process that we are following, and to see that we are able to do it on a sustainable basis for a longer period of time. These are standard disclaimers that is there. Okay, and I think that's it. And if you have any questions, do write it to us at equity@shree-rama.co.in or equity@intelsense.in. Thank you. Thanks for listening, and have a wonderful day.